If you're a business owner, you know the feeling. You look at your finances and it just feels like, well, chaos. But what if you could turn that complete mess into something crystal clear? So today, we're going to dive into the system that does exactly that, the ledger.
I mean, does this look familiar? You open up your records and all you see is this jumble of transactions, one right after the other. It's almost impossible to see the big picture when you're buried in all those tiny details. Okay, let's say you're running a coffee shop. Your records probably look something like this, right? You bought some beans, paid for milk, rent was due, you made a sale, then another sale, paid the electric bill. It just keeps going. Now, if I asked you a simple question, hey, how much did you spend on just coffee beans this month? Good luck trying to figure that out from this list. It's a total nightmare. So what's the fix for all this chaos? Well, there is a system designed for exactly this. It's called the ledger. And honestly, the best way to think about it is like a financial filing cabinet. It's the one place where every single one of those transactions finds its perfect, proper home. Okay, so what is a ledger, technically speaking? It's where we take all those messy journal entries from that long list and we sort them. Think about it. Every transaction that has anything to do with cash gets dropped into a cash folder. Everything about sales goes right into the sales folder. It's basically the master organizer for your business's finances.
So why do we even bother with this? Well, it's for three absolutely crucial reasons. First, it groups all the similar stuff together so you can actually see what's going on. Second, it lets you calculate the final number, the final balance, for each account, like finding out exactly how much cash you really have left. And maybe most importantly, this organized data is the rock-solid foundation for every single important financial report you will ever create.
All right, so we've got our filing cabinet, the ledger. But how do we actually get the paperwork into the right folders? Well, that process is called posting. And trust me, it's way simpler than it sounds. Let's take a look at how it actually works. Posting really just boils down to 4 simple rules. You're basically just matching the debit from your first entry to the debit in the ledger and the credit to the credit. Then you use these little prefixes, to on the debit side and by on the credit side. Don't overthink them, they're just labels to keep things tidy. It's all just a methodical process to make sure everything lands in the right spot. Let's make this super concrete with a clear example. Your business paid rent with cash. Simple enough. In accounting, an expense like rent goes up, so we debit the rent account. And an asset like your cash went down, so we credit the cash account. Now here's the posting process. See how that one journal entry gets filed in 2 separate places? In our rent account folder on the debit side, we write to cash account. Then we pop over to our cash account folder, and on the credit side, we write by rent account. Just like that, both sides of that single transaction are filed away perfectly. And this is where all that careful filing pays off big time. We can now super easily find the final balance of any account we want. This part is called balancing, and it's how we get those clean, simple answers we were looking for from the very beginning. So let's look at our cash account. On the debit side, the left side, we have all the cash that came in, a total of $1,050. And on the credit side, the right side, we have all the cash that went out, a total of $700. To find the balance, you just figure out the difference between the 2 sides. And boom, there it is. Cash in minus cash out gives us a final balance of $350. That's it. No more guesswork, no more digging through some messy, endless list. We have a clear, accurate number. Now that is the power of the ledger. And when you do this, you start to see this really cool natural logic in accounting. Accounts that represent what your business owns or what it has spent, things like assets and expenses, they'll almost always have a debit balance. And accounts that represent what your business owes or has earned, like liabilities and income, they'll normally have a credit balance. It's a system that just fits together perfectly.
So let's zoom out for a second. What's the really big picture here? This isn't just about organizing a few accounts. Each one of these balanced ledgers is a building block. Together, they create the entire financial story of your business.
And getting this right is, well, it's completely non-negotiable. An error in posting, even a tiny one, doesn't just stay in the ledger. No way. It corrupts the next step, the trial balance. It completely messes up your profit calculation. It throws off every single financial report you generate later on. The ledger is the foundation, and if that foundation is cracked, the whole building is unstable. At the end of the day, it all comes down to this one simple idea: reliability. Your ability to actually trust your own financial data, to understand the true health of your business. It all comes down to proper posting and balancing. That's the heart of reliable accounting. So, I'll leave you with this thought. Your financial data isn't just a list of cold, hard numbers. When you organize it properly in a ledger, it becomes a narrative. It becomes the story of your business's journey. So the real question is, what story is your ledger telling you?